As we know, the US dollar so influential right now with the gold move. Let's bring in Markus Helsing from Alpha Broking, who's joining us live in our Melbourne studio. Markus, thank you so much for joining us this afternoon. Do appreciate it. Now, I know we often speak to you about that US dollar move, which has been under some pressure after, you know, all of the US political situation, Donald Trump withdrawing from the TPP, and it's been very interesting watching the moves in the commodity space. What's your view on what's happening right now?
Well, hi, Leanne. Great to be on the show. Look, to us, really, this 8-year US dollar bull run is in its final leg. We expect, we've probably already seen some of the initial reactions of that in key currencies, such as the Aussie dollar as well, but the yen as well. I mean, US yen had just a run of a lifetime over the last 3 or 4 years. So really, if you focus on the Aussie US just for a minute, we really believe, and we have changed our macro view, by the way, from sideways to bearish to actually outright long-term bullish. Now, that might be looking as though we're going to be carried away with the latest move, but if someone actually assesses our terms of trade, our move on the Aussie US over the whole technical setup after the sell-off from 110 down into the high 60s, I think 68 or thereabouts was the low we made, currently hovering around the 75.5, give and take. We really believe if you see iron ore trading at $80 a tonne, as it is the case now, with the 12 months forward backwardation, forward prices, in other words, trading at a roughly $16 discount, this is a tremendously good news story for Australia. So if you can hold that just for another 6 or 12 months, that in itself could be responsible to lift the Aussie dollar past the 77 mark that everyone is looking for. So we really believe in its own right, with Australian domestic news in itself, we have a support on the Aussie dollar. When you look on the big picture on the US dollar, everyone looked at US yen and Euro US, the major currency pairs, and we all know that Europe has its own problems, probably so does the US and Japan, of course. So, yeah, of course, at some point we're going to see a euro at parity to the US and US yen, God knows where. But the fact is we have an 8-year US dollar bull mark behind us. That's, in all terms, considered a very mature bull market. So I think the risk to the US dollar is much more to the downside over the next 2-3 years than to the upside.
Just on your comment on the iron ore price, and I think there was a big if there, in there, you know, that is if it holds at $80 a tonne or higher. Right now, are the supply and demand fundamentals strong enough to actually support that price at $80, sustainably support that price, I guess, going forward?
Well, who knows? But I mean, we see basically for the next 3 to 6 months, this should be holding give and take in a $70, $80 range, or even $75, $85 if someone gets a bit carried away. Because if you look at copper, which is really the barometer for many base metals, inclusive industrial metals, you can argue that iron ore actually rallied way before copper. In a way, is in a price lead to copper, and copper is barely catching up with what's happened with the like of iron ore. So we do believe this is a Goldilocks scenario for Australia in particular, and any exporter such as Australia. But I think this is a great story, but it should be seen as a time to really reassess where we're really heading on the big picture. And we believe this is as good as it gets, and the longer it stays here, and the longer copper rallies and iron ore holds here, the better for Australia. This is a time to start batten down the hatches for more volatile times. I mean, China at this point looks very stable. Is it expected to stay that way for the next 5 years? Probably not. So this is a time to really enjoy what's coming our way, but not to be blindsided by that and just do nothing. I mean, this is really for us a time to start looking and preparing for much rougher seas ahead.
Markus, it's James here from Rivkin Securities in the studio. I just want to touch on something you mentioned there, battening down the hatches and this expectation that we will see some type of volatility in the next few years. With that in mind, if you're a retail investor in Australia right now and you're looking for that, how would you look to protect yourself?
Well, it's a very good question. I mean, look, we have a demographic time bomb. I mean, the first baby boomers, they're already well in retirement. I'm one of the sort of the laggard ones, having been born in 1960. But I mean, the bottom line is we're going to have a demographic shock to the system. And that comes after an enormous period of money printing and excessive behavior in credit markets and credit behavior of consumers. So in essence, we are very, very ill-placed for any shock that might come our way. We believe for any retail or wholesale investor, for that matter, any investor, from here onwards, they should have absolute minimum of 10% in physical gold or gold stocks, and they should really reassess their portfolios going forward. It doesn't hurt sometimes to have a bit more cash than being fully invested. This whole love affair with dividend stocks has been a tremendous bonanza, has been fantastic for investors, and as we all know, the greater something is and the longer it lasts, the bigger the bust. So we basically believe there's a very fair chance we're going to see some major tops in world asset prices from real estate to stock markets over the next 12 to 18 months. And any investor should reassess their involvement with any investment now, because it's a brilliant time to rejuggle investments and get a lot more conservative overall. And because at the end of the day, an investor's responsibility is to themselves to protect the assets that the particular investor has. And we believe going forward from here on is play the run, because we believe this run still has a few legs on it, but start to prepare for rougher seas.
Markus, it's Michael Wayne from COSEC. Taking things back to a bit of a shorter-term perspective, when you're looking at the gold price at the moment, what is your breakout price? Well, if you can breach, what level at the moment do you think it will continue to run from?
Good question. I mean, look, it had a good run, obviously, Jan to June last year. The correction we had the following 6 months until later in December was just a brilliant pullback. We think platinum actually is a much more conservative price guide and gives you a bit of an underwrite of a particular directional move. And we've seen platinum jump up last night a bit, but we really would like to see a solid close of platinum above $1,000 an ounce. It's currently around the 980 on a weekly, monthly close. Technically speaking, that to us would be a good underwrite. With gold, well, it's got to basically see a clean break of your 1350 levels to really see an advancement, or a $20 hold in silver, and we're still a far way off that. Look, while we do like gold and silver as a diversification in a very big way and related gold stocks, this is of course not the only play. But to us, to answer your question, we believe 1350 is the line in the sand where people really should have a very close eye at gold at 1350 and $20 in silver.
And with that in mind, if we do in fact continue to see it moving higher, I mean, are there still opportunities in those gold stocks?
Well, that's right. I mean, I've been out there quite a bit about some of the US and Canadian stocks that are lagging much more behind for some reasons of their past dealings with debt, that they got obviously really sold off much more aggressively in a 4-year bear market that we had between 2011 and late 2015. And I think the new managements of many of these companies have addressed that, and they offer a lot of potential. So Barrick Gold, New Gold, Gold Corp, to us are a great hold. We think they've got a tremendous potential. Here domestically, Newcrest already has a lot built in, and it's a hard stock to laugh. I mean, we are long Newcrest, but it's built in a hell of a lot already. We do like more junior miners, such as Silver Lake, for example, or investors who want to have a broad-based investment should consider maybe a share investment in a junior miner ETF, an exchange-traded fund that really covers all the sort of small miners in a very nice way. And that, to me, is an investment that we are long in, and we really believe that has a lot of legs to it.
Mm-hmm. All right. Can we talk oil prices? Just watching Brent crude, what is it at about $55? US NYMEX crude at about 53 right now. I suppose investors are still a little wary of higher oil production coming out of the United States with the support that we're seeing in the oil price. What is your, I guess, longer-term view on where we could see it heading?
I think I've seen a lot of reports, and really the technical guys still see there's a potential for one more fallback towards 50 or 48. I think that would be a tremendous opportunity to add to current long positions. Really, I think the action from Trump straight away in his first 2 days Yes, for example, the oil pipeline from Canada to the US, to me, does underline we're not living off solar or battery-powered sort of a household yet. We're basically globally, but strongly dependent on oil and coal, for that matter. And in my view, that will stay like that, unfortunately, for a much longer period than we'd wish for. So in essence, the supply-demand scenario, we do expect that to come into line by mid-year. We've got currently now delayed, but a very cold winter in Northern America and, of course, in Europe. And that will make sure that stocks will draw down. So we really believe the target of 50 to 65 over the next 12 months in crude oil to be a realistic target. And we do think that the US frackers will probably get more back on deck once you see a solid base above $60 a barrel. Because let's not forget, many of these frackers, they also need financing. And many of the banks who financed previous frackers that went bust obviously are hurting. So probably these bankers will reassess that and probably won't jump back in and financing all these frackers all over again. So while there was a consolidation, of course, it probably will not be the frenzy that we have seen when oil was at $100 a barrel.
All right. Fantastic, Markus. Always insightful, wonderful comments from you. Thank you so much for joining us.
Thanks, Leanne.